It's Friday. What more do you need to know? You're in the right place, folks, because this is where the money is. Welcome to the show. Like I said, it is indeed Friday. I'm Matt Koppenheffer. This is David Hanson. David Heather, our trusted producer, is out of the office today, so we've got a little bit of a special show format. It's still Friday. It's still interview day. We've got a great interview today from Mike Olsen, who works on our $1 Million Portfolio product. But first, let's do some mailbags. We've got 3 mailbags here. Let's start off with the first one. This email is from Mark. Mark writes, "Hey guys, great show. I just bought my first stocks ever, Progressive. I did this based on Inside Value's recommendation and my own research. They had just paid their dividend and their 10K and conference call were going to happen the next day. Progressive is now up around 2%. I thought their annual report looked good. The company seems to be very good at managing risk, and I like how they have a slight upper hand over other companies because they sell directly to the consumer, allowing for a higher margin like Geico. I think Progressive definitely has the potential to grow over the next few years. What do you guys think?" David, what do you think?
Got to applaud him for buying the first stock, right?
Yeah, that's huge. That's huge. I mean, regardless how that turns out, that's a great way to learn. Buy it. Make sure to record thoughts in an investing journal of some sort. Know why you did it so that you can go back and look at it and evaluate in retrospect. But that's a big deal. So Mark, wait, where's our? There we go.
And the Inside Value. We had Joe Mager on a couple weeks ago.
Well, yeah,
a very trusted mind.
We're
there.
big fans of Inside Value here. They've got a lot of financials in that portfolio of recommendations, and one of the best performing was the best performing, wasn't it? Newsletter over the last 5 years, as seen in the Wall Street Journal.
To get to Progressive.
Yeah. Now stop dodging the question. Get to the Progressive.
I like Progressive. I like the company. I think the stock is pretty attractively valued today. In the Inside Value recommendation, I think they just recently re-recommended it also. I believe they said it's the most quote unquote hated stock amongst Wall Street analysts right now, which I don't really understand why. You look at the history of Progressive, they've been an innovative company with technologies, with being a direct insurer here. They've had good underwriting results here. They don't have the flashy investing team like a Markel or a Berkshire Hathaway, but a fine investing team there, good underwriting. I think it's a good model, and I am not one of the people who believe that car insurance and Progressive is going to go the way of the dodo bird because of driverless cars.
Robots are going to kill everything. I think one of the reasons that Wall Street may not like Progressive is I think Progressive has kind of a history of not really playing Wall Street's game. Progressive does what it does, runs its business, and kind of says, hey, Wall Street, you can figure out you can figure out what we're doing. Although they have made some concessions here and there. I think they give some monthly reports that help bring greater clarity. I think Progressive's a great business. It's actually probably one that I should look at more closely, particularly given the confidence that Inside Value and Joe Mager has shown in it. I do like the direct insurance businesses. We've talked about this a few times on the show. We talked about it in particular in terms of Allstate and how Allstate is still very much an agent-driven business, even though they have the smaller Esurance brand in there. And for WTMIers that may not recognize right off, Geico, very direct insurance business that's owned by Berkshire Hathaway, of course. That's a great business, and it's probably the best comparable is Progressive.
Right.
And I think they're both great, well-run insurers.
Maybe one of the reasons that it gets on Wall Street's radar for being a hated stock is that it does look pricey on the face of it compared to some other insurance companies. But like you said, Geico is really the best comparison here, and that's not a public company. So
right, you can't
say,
evaluate that.
Oh, the Geico multiple is this and Progressive's that. We can't say that. So yes, there's the Esurance business, which is now up under Allstate, so we don't get a clear picture about what Esurance is looking like either. So maybe the fact that there's not a really clean comp makes it a little bit harder.
But also, when is Wall Street so hung up on multiples that they hate a stock just because of that? I don't know, maybe sometimes. But anyway, bottom line, Mark, I think I can speak for both of us. Good pick in Progressive.
Definitely.
Congratulations again on buying that first stock.
Cool.
Before I go to the second question, I forgot to mention right off the top, it's the email address that gets everybody to us, gets these emails to us. That email address is WTMI@fool.com. We love getting these emails. Number 2 comes from Matthew. Matthew starts out with a little bit of House of Cards because we had talked about this on the show there's a character on House of Cards named Raymond Tusk. And Matthew, I forget who he was comparing Raymond Tusk to.
Blankfein.
Blankfein, right. And we said, no, it's probably not Blankfein. We think it's Warren Buffett. And at the time, I had not started the second season of House of Cards. Now that I start watching the second season of House of Cards, the Buffett connection is waning for me.
Both Midwest billionaires, but not quite in personality here.
Yeah, so Matthew writes, does the real-life Buffett have some greedy, president-wrangling, bird-murdering evil side that only insiders know about? Is it possible in real life to become a billionaire if you're just a nice guy? The story of Warren Buffett is more complicated than the folksy, hamburger-eating, Coke-drinking image that I think a lot of people have. But I don't think he's a bad person, and I don't think he's a I don't know, a corrupt person.
He has to be a different person when it comes to the negotiating room. There's no way he's, like you said, the folksy old man wisdom kind of guy. When you look at the actual deals, he's a ruthless negotiator just by looking at the numbers. I mean, the deals he gets are unbelievable, but it's not just, it's part of it because people want to say, well, we're doing business with Warren Buffett.
But I don't know that ruthless is necessarily even the right way to describe it. He just has such good timing in terms of what he's doing. So if you think back to those great preferred stock investments that Buffett got during the financial crisis, I don't think it was he had to get into a room and beat people down. I think in the case of Goldman Sachs, in the case of GE, it just kind of came out and Buffett said, well, here's what I'll give you.
Yeah.
And it wasn't I'm gonna work you down until you this is the offer. I'm Warren Buffett. We have a lot of money. We can give you money. We can give you market confidence. Here's the price.
Same with Bank of America as well. 2011,
right.
A very tough time for them. I guess the one outlier in the recent years has been the Heinz deal. He did get a pretty good deal on that. They have 50% equity in the company, and then they have the preferred coupon. You could say that's a pretty good deal for him.
Yeah, but again, the question is how much of that was a hard backroom negotiation versus. Anyway, let's get to the rest of Matthew's question.
He actually had a question.
I really like this. He talks about the future. He said, recently read about how Intel and maybe others employs a full-time futurist to help predict social, economic, technological trends. Your thoughts on the following future possibilities? Yes or no? Will the following become enough of a reality in 10 to 15 years to significantly,
like a rapid fire?
Yes, to significantly affect a related business? Here we go, David. Number one.
Are you answering too?
Sure.
Okay.
Of course. Number one, driverless cars make collision insurance obsolete. He refers specifically to Geico here, among others.
10 to 15 years, no way.
I'm going no as well. Number two, global food culture shifts, dramatically reducing sugary drink consumption, and he refers here to Coke in particular, although you could probably bring up Pepsi here as well.
United States, maybe a little bit. Global, no way.
I'm going to say yes. Ooh. I'm going to say yes because the U.S. is such an important market. I don't think it would kill Coke.
The Chinese consumer not drinking Coke?
No. I'm saying primarily the U.S. market change could have an impact.
All right.
Number three, home 3D printing significantly disrupts shipping of physical products. Thinking about FedEx here.
No.
I'm going no as well. Number four, online and mobile payment players offer retail banking and loan services. Thinking about PayPal, eBay's PayPal.
Yes, absolutely. The financial industry has been the same way for 100 years, and it'll probably continue to be similar in some respects, but there will be new players kind of offering better, more innovative services.
I got to say yes as well, and I'll broaden it out, not just mobile online payment companies, but also maybe a Facebook, maybe a Google, getting into that. Not owning a retail bank, as we talked about before, but having the services and working with a white label bank. Number five, low-cost online higher education gains real legitimacy, significantly disrupting bricks and mortar colleges. David, what do you think?
That's a tough one. Next 10 to 15 years, no, but 50 years, yes. What do you think?
I'm saying no and no.
Okay.
I think the on-site college experience is a good one, offers a lot more than the online
Still touting
courses.
That Ivy League pedigree you got.
It doesn't have to be about Ivy League. It doesn't have to be about Ivy League.
Yeah.
Number six, routine medical checkups are completely free of human doctors. Thinking about IBM on this one.
Sure, why not? Nobody likes going to the doctor, so I'd like a free machine.
I'm going with no. Gotta love that. Turn your head and cough. Number 7.
Do you love it?
No, I don't. Number 7. Actually, my doctor doesn't do it. Funny side story. I'm at a great medical practice, kind of a startup type of medical practice called One Medical, and my doctor finished his checkup, and I said, "So no, turn your head and cough." He said, "No." He said, "I'm very results oriented." He looks at the research and he said, what you end up with that particular test are more false positives and more unnecessary tests and all kind of other stuff than actually identifying more problems.
Some free promotion for One Medical.
For One Medical, great company there. Number 7, battery powered vehicles outnumber gas powered vehicles. And he's thinking about Tesla, that would be on the positive side, and Exxon Mobil getting hurt.
Outnumbered in the next 10 years, no, but it'll be a very significant portion, I think. It's just because cars stay on the road for so long now, the turnover of cars wouldn't be able to take a majority in that short period.
Fully battery powered, no. But if you consider, if you loop hybrids in there, I'll go with yes.
Okay.
I'll go with yes. I'll go with the outlier. Number 8, also he said 10 to 15 years. I'll go 15 years on that one. Number 8, man-made machine will become self-aware.
No.
No, unfortunately.
Unfortunately not.
I wish, but no. Number 9, alternative energy sources, wind, solar, and hydro produce more power than fossil fuels.
Not 10 to 15. Sorry. What do you think?
No.
We'll ask the energy guys.
Yeah.
Submit that to Digging for Value. We'll pass it on to them.
Yeah, the Digging for Value show, that's another show that you can tune into here. That's on a weekly basis, right? Mm-hmm. Number 10, final one, major low-wage employer becomes unionized. He's thinking specifically about a Walmart or McDonald's.
Gotta go no. Can't see unions sticking out.
We're agreeing.
Too much longer.
We're agreeing way too much. We hang out too often. I've got to go no on that one as well. Matthew, that is a great question, great list of scenarios there. Let's finish off. Third question here. This comes from Alejandro Sanchez. Alejandro asks, actually he's got more of a statement here to start with. He said, would like to point out that the tax you mentioned, this is that bank tax that's in both the Republican and Obama's proposed budget, that are proposing for banks is too big to fail, is not randomly targeting them as you stated, or to just get some tax revenue. It is being proposed because of what they did and how their past behavior caused, or at least was a significant reason for the recession. Therefore, due to major risks they pose to the financial system, the proposed tax makes sense. I would agree with you the unintended consequences, banks hiding assets for instance, would be undesirable. There needs to be a way to assure that private institutions in the hands of few individuals, which sometimes can do stupid things, with potential to cause a worldwide crisis, cannot do it again. Or what do you think? Now, I kind of agree with this. It's not randomly targeting in that, yes, this is a group that was, that brought itself to the limelight because of the financial crisis. However, we talked about this a little bit because I said to you that one of the ways you could justify this sort of tax, you could call it a too big to fail bailout tax and essentially say that because these banks are still too big to fail and would need to be bailed out if we had a similar crisis again, you tax them extra and you say, we're taxing them because they cost us.
Almost like an FDIC bailout fund.
Right. The problem is, and this is what you wisely said to me, the problem is that then you institutionalize the idea of bailing out those banks. So without having that, then you're just saying we're basically randomly taxing this group. Not that that is totally out of the realm of thought for the government to do. I mean, you think about tobacco companies get extra taxes on them, and their products get extra taxes on them. Alcohol, liquor companies, gaming companies. But I mean, the question is a bank really in that kind of group? I mean, those are kind of sin taxes in my mind. I don't know. I still stick with the idea that I think this is good politics and a way for the government to raise money.
Yeah.
As opposed to truly this is a reasonable tax that unless
I think it probably is because they're too big. They can't explicitly do that because then
so it is because of the bailout, but they just can't say it's because of a bailout.
Right. I mean, because you can't make it explicit because then you get to even though Fannie and Freddie weren't explicit, essentially everyone knew that they would step in. You can't do that. It encourages reckless behavior.
But I mean, and again, we think back to TARP, the TARP fund that's been paid back, right? hasn't really been, and well, the part of it that hasn't been paid back, or the biggest part of it that hasn't been paid back, has come from the auto companies, right? So maybe we should be thinking about not let's put an extra tax on the financial companies because that's obvious. Like that's the good politics. Let's tax the auto companies extra because they did stupid things. They needed a bailout.
Now you're campaigning.
Well, I'm just saying. I'm not going to win any elections on that stance. Let's not tax the banks. Let's tax the auto companies instead. I'm going to lose every election hands down on that platform. But I mean, it's again. I think it's good politics in there, and good in kind of a quote unquote kind of way.
Can we both agree that too big to fail? I mean, I don't want to get into a huge discussion here. Too big to fail still does exist. I mean, Bank of America couldn't fail today.
Right.
So it's still. I think the only way to have gotten rid of too big to fail was to break banks up. I think that's the only real way to do it.
I don't know. I like to think that there's a way to kind of wall off a bank, allow its assets to be transferred without causing a bank run, and kind of wind it down, as opposed to or distribute the assets into good homes for them. I like to think that that's a possibility. I don't know whether we've gotten there yet, but
I'll tell you what. I'm glad it's not my job to figure it out.
And I should point out, that's a good point. I should point out that the U.S., this whole too big to fail thing in the U.S., this isn't like an isolated thing in the U.S. Actually, the banking system in most other countries,
more concentrated.
More concentrated, and they don't call it too big to fail. But if you called it too big to fail there, that's been the banking system for a long time. This whole distributed thousands of banks thing in the U.S. is actually pretty unique. Going on to the interview, we've got an interview today with Mike Olsen. He's a senior analyst with our $1 Million Portfolio product. We talked a little bit about Berkshire Hathaway. Let's go ahead and cut away to that interview right now. Hey folks, I'm here today with Mike Olsen, senior analyst with the $1 Million Portfolio here at Motley Fool. Mike, thanks for joining us.
Thank you.
It's a big week for lovers of Warren Buffett and Berkshire Hathaway.
The love fest is on.
Yeah, the shareholder letter out, plenty of good reading material.
Yes.
But let's talk about the bear case at Berkshire Hathaway. There are a few scenarios that people are concerned about when it comes to Berkshire stock. What do those look like?
Right. So I think Berkshire is very interesting for the fact that it is one of the most widely loved and sort of serially unappreciated stocks. And I think that kind of owes to its success because there's sort of a cadre of folks who always say that on account of Berkshire's size and its success, the likelihood that it will continue to outperform the S&P is accordingly limited, just because you have sort of a law of large numbers effect going on. The second, and it's sort of part and parcel to that, is that Warren, for all of his wisdom, folksy aphorisms, and Coke consumption, will someday or another not lead Berkshire, and accordingly,
Coke isn't the fountain of youth after all.
Right. Coke is not the fountain of youth after all, and indeed its returns will decline because he's just such a remarkable capital allocator. And the last is that Buffett has said he will repurchase shares of Berkshire at 1.2 times book value. And so there's sort of a school of thought that goes, if Buffett will buy at 1.2 times book value, why should I pay any more than that?
Okay, so we've got the fact that Berkshire has just gotten too big, the fact that Warren Buffett won't be around for forever, and the fact that the shares are just trading above where Buffett had said he'd buy the stock at Berkshire. Are these scenarios that keep you away from the stock?
No. I personally am in
spoiler
shot of the stock, and also, spoiler, we do own it in MDP. Okay. As for the matter of it being too big of a company, I think that this kind of misses the broader point. And the first being that Berkshire as an entity has dramatically evolved over the years. And at its core now are two sort of industrial capital or regulated capital intensive businesses which have enormous reinvestment needs, and they continue to earn very attractive returns on capital and equity. Those are Burlington Northern Santa Fe, the largest rail in America, and Mid-American Electric Holding Company. That is their utility business. Both of these businesses should be able to reinvest in them at very attractive rates of return for decades running. And on the matter of its insurance operations, you also have Geico, where I would argue that
Pretty good business.
pretty good business, and I would also argue that as Geico grows larger, its ability to continue to grow actually increases, because what happens is it realizes cost advantages on account of its scale. That allows it to pass savings along to its customers, and in turn allows it to write less profitable business at a still attractive rate of return.
Okay.
So you put all of this together, and basically I think we can both agree that Berkshire has kind of an above average stable of businesses, which in aggregate should earn pretty attractive returns on capital and equity.
Okay, I'll buy that.
Sure.
Speaking of buying it, at MDP, you guys have rated rated Berkshire a buy and given it a price, a valuation of $147.
Yeah.
So, in assigning a price like that, what kind of returns assumptions are associated with that? Because you can say that something is fairly valued or undervalued on a theoretical basis, but investors still need to know what kind of returns can I expect from that stock?
Right. I think the way we sort of think about Berkshire at MDP is we kind of think of it as an equity bond, and that sort of goes to the idea that you have a very attractive, stable, relatively low risk businesses, which should modestly outperform the S&P. The other thing you have to consider, in addition to the fundamentally attractive growth prospects and return characteristics of its businesses, if Berkshire doesn't have any use for its capital, it can simply reinvest it in the market. So on a de facto basis, it should be able to grow at or above the market rate of return. We believe that on account of the quality of the businesses and its growth prospects, it should outperform the S&P by just a little bit over passage of time. Okay. I kind of hew to the idea or the belief that Berkshire, that Buffett also holds, which is that in the good years, it's not really going to blow out of the water. So you don't have a collection of growth businesses here. Right. But in aggregate, these are very attractive businesses, which I think we can argue 20, 30 years from now will look much the same as they do now.
Great. Well, thanks so much for joining us, Mike.
Thanks, Matt.
All right, we're back. That was great to hear from Mike. David, let's finish off today, finish off the week, as we always do in the Twitter sphere. What's our tweet?
Our one and only tweet is from Brooks Running.
By the way, Berkshire Hathaway company.
Yes,
Brooks Running.
So much Berkshire.
So much Berkshire.
Who gave you your first piece of running advice? Nominate a coach who inspires you for the hashtag inspiring coaches. Running advice? My best at running advice was to not run.
Who gave you that advice?
It's hard. Takes the wind out of you. What was the best advice?
But who gave you the advice?
I don't know. Someone
somebody. In terms of being inspired to run, I do a lot of running. In terms of being inspired to run, that was my mom. This was just about 5 years ago. She decided to run the Las Vegas half marathon, and it wasn't sort of a request. It was, hey, you should run this with me. So, but as far as advice goes, I had a great running community when I lived back in Las Vegas. A few guys out there gave me some, I can't even say all of the advice, just lots of great advice. But going from running to investing, I think just as I've benefited a lot from having mentors and people who have been able to give me advice on running, I think it's just as important, if not more important, in investing. David, who gave you your first investing advice?
Oh, wow, my first. Roommate in college.
What was the advice?
It was more of an advice what not to do.
Okay.
He was trading FX currency and lost his shirt. So,
so did he give you the advice, or did you just watch him?
It was a learning advice, but he now realizes that he made
this was
errors.
Real life.
Exactly. What about you?
Well, my first major interaction with the stock market was in high school. We did a stock market game in my economics class, and that was disastrous. I think a lot of stock market games are, because it was all focused on we
3
have
months. It's
we
ridiculous.
have 3 months. You pick a stock just randomly. There was no guidance as to how you figure out what to buy. So my first real advice on buying stocks came from the Motley Fool, and it was about accessing SEC filings, how to read them, what to take away from them. And I can remember reading the AOL Time Warner 10K back in whatever it was, 2000, I think it was, before the crash. I read it, I had no idea what most of it meant, and I ended up buying AOL and losing my shirt. But I was at least able to say, well, here's where I can go to find information to figure out what's behind this company and what it does.
Speaking of the Motley Fool, next Friday, we'll be running the full interview that you did with the guy who started it all, David Gardner.
David Gardner.
Talk about some good investing advice. Be sure to tune in next Friday as well. Great interview.
This was an interview I did a few months ago, but it is timeless. It's timeless. So that'll be a really exciting interview.
Cool.
Well, that's the show for today and for the week. If you're not listening to us on iTunes, you can go there and find us. If you are, give us a rating. Let everybody else on iTunes know why they should be listening. I'm Matt Koppenheffer. This is David Hanson. We will see you next week.
People on the show may have interests in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.